Hello everyone. Today, let's dive into the whirlwind that was the 2008 stock market crash. Buckle up because we're going to break down the core causes, key events, and aftermath of this financial disaster. First up, the core causes. The 2008 crash was precipitated by a housing bubble. Years of low interest rates and relaxed lending standards led to skyrocketing home prices. Banks issued subprime mortgages to borrowers with poor credit. These loans often had adjustable rates which became unaffordable as interest rates rose. Now, these risky mortgages were bundled into mortgage-backed securities or MBS and sold to investors around the world. This process, called securitization, spread the risk far and wide. Then came credit default swaps, or CDS. These were unregulated insurance-like derivatives on MBS, and they magnified losses when mortgages defaulted. AIG's inability to pay out on these contracts was a key trigger. Add to that, decades of deregulation, from the 1980s to the 2000s, which led to increased risk-taking by financial institutions. Major laws like the Garn-St. Germain Act and the Graham-Leach-Bliley Act played significant roles in this deregulation. Let's talk about the timeline. The first major sign of trouble was on April 2, 2007, when New Century Financial, a major subprime lender, filed for bankruptcy. By July 31, 2007, Bear Stearns was facing massive losses. The stock market reached its peak on October 9, 2007, before starting its downturn. By December 2007, the U.S. had officially entered a recession. March 2008 was a turning point. Bear Stearns was acquired by J.P. Morgan Chase in a government-brokered deal. In July 2008, IndyMac Bank failed, and the Dow fell below 11,000. On September 6, 2008, the government took over Fannie Mae and Freddie Mac. Just 9 days later, on September 15th, Lehman Brothers declared bankruptcy, sending shockwaves through the financial system. The panic continued on September 16th when the Reserve Primary Fund broke the buck, triggering panic in money markets, and AIG received a bailout. On September 29th, the Dow plunged 774 points, its largest one-day point drop at the time. The following week, October 3rd, the TARP, or Emergency Economic Stabilization Act, was passed. However, the market continued to fall, bottoming out near 7,882 in early October. By March 2009, the S&P 500 hit its lowest point at 676.53. Now let's discuss the consequences. The crash led to over 8.7 million jobs lost, and nearly 10 million families losing their homes to foreclosure. Household wealth took a significant hit as well. In the aftermath, major reforms were introduced. The Dodd-Frank Act brought increased regulation and consumer protection. Banks and mortgage lenders faced heightened oversight, and stress tests were implemented to ensure the stability of financial institutions. To sum up, the 2008 crash was a perfect storm of risky lending, financial innovation gone awry, and regulatory failures. The Dow Jones peaked at 14,164 on October 9, 2007, and bottomed out at 7,882 in October 2008. The S&P 500 hit its low at 676.53 in March 2009. AIG required a $150 billion bailout, and the Fed funds rate plummeted from 5.26% in mid-2007 to just 0.16% by the end of 2008. Thanks for watching. If you found this breakdown helpful, don't forget to like, subscribe, and hit the bell icon for more deep dives into financial history. See you next time.